In this video, let's talk about two small cap ASX growth stocks that's in the e-commerce space. If you're just here for the stock idea, the stock I'm covering is Kogan and Temple & Webster. But honestly, I think you'll find what I
found inside these companies to be way more interesting.
If this is your first time here, my name is David. I am just a shaved head Asian dude with a toy otter in the background. By the way, his name is Otto. So the one thing you should never do when it comes to my videos is to use it as financial advice. If you do need help with investing, make sure you talk to a real professional. And as usual, if you learned something brand new, make sure you gently smash that like button right there, and that will mean the world to me. So without further ado, let's go! First things first, whenever you're assessing the quality of a growth stock, you're honestly looking for three simple things. One, do they have a product or service customers love? Secondly, is the business model scalable? Third, are they able to scale that business profitably? For each of the small cap ASX growth stock, I'll show you how I answer all three questions with commentary around their moat and risks. So let's start with Kogan. Now we all know Kogan as an online retailer where you can basically buy anything you want. And now they're also in credit card, internet, and mobile business. And to answer the first question, whether customers love Kogan as a product, the easiest way to tell is via repeat orders. In their investor presentation in June 2020, you can see that there's a very sharp increase in repeat orders during March, April, and May. Even before then, you can see a general uptrend when it comes to repeat purchases. And that's also a good sign that the customers are loving the product. Another way to tell whether people are loving the product is via Google Trends. Google Trends take into consideration how often a keyword or brand is searched in a given month and location. So as people search for Kogan more and more, you see an upward trend over time. So the blue line is JB Hi-Fi, green line is eBay, and the red line is Kogan. So you can see that Kogan is slowly catching up. Now just remember that Google Trends is a weak signal. Nothing beats actual repeat transactions. When it comes to the scalability of a business model, you're essentially looking for how fast can a company adapt to consumer demand. If you're a physical retail store, it'll take you months just to open up another store, hire people, just so that you can cater for more demand. On the other hand, it will take Kogan days, if not hours, to essentially add more processing power behind the website. Not to mention, it'll be a fraction of the cost compared to opening up another physical location. So, is Kogan's business model scalable significantly more than physical retail stores? And to tell whether a business can meet consumer demand profitably, all we have to do is look at their income statement. In their latest investor presentation for raising an additional $100 million, their cost of doing business, which is the operating cost divided by the gross sales, went from 11% to 10%. Just to show you the mathematics, just go 55.4 divided by 499. That's approximately 11% cost of doing business. And that's in financial year 2019. If you do financial year 2020, then it'll be 68.4 divided by 674. And it went from approximately 11.1% to 10.1%. And that essentially means that as they generated 35% more sales, their cost of business as a percentage went down. That's a signal that Kogan can meet a higher consumer demand while maintaining or even lowering their cost of doing business, which is freaking incredible. To add more confidence that this is a high quality small cap growth stock, as of 31st of May 2020, without taking into account the 120 million capital raising they just did, Kogan's current assets, which is approximately $169 million, cover both current liabilities and non-current liabilities. So there is definitely strength in balance sheet to weather the storm for the rest of the year, not even considering the amount of cash that they have after this balance sheet gets updated. So if you're wondering whether Kogan can scale their business profitably, just by looking at the income statement and the balance sheet, yes, they absolutely can. Now in terms of Kogan's moat, repeat orders are glimpses of Kogan becoming one of Australia's leading online retailers, but they still have a lot of work to do to catch up to JB, eBay, and Amazon here in Australia. On the topic of risks, the biggest risk for Kogan currently is whether consumers will keep spending after the government slowly reduces those stimulus packages. Personally speaking, the value Kogan add to a consumer's life is actually the same product at the best price. As people's belts get tightened, I anticipate that they will do more research on the same product and try and find the best deal possible, and Kogan would definitely benefit from that. And along with access to buy now pay later type arrangements like Zip, Afterpay, or even Kogan Money, consumption in my opinion will still be there, especially as we head towards Christmas. One last thing, Kogan is a founder-led company, and Russell & Kogan still owns majority stakes. He is hustling like he just started this company. This is why I deeply value founder-led businesses, because this is their life's work, and there's just no chance anyone in the company will outwork them. Full disclosure, I own Kogan in WAM Research. Next up, we have Temple & Webster. Temple & Webster is an online retailer focusing on furniture and homewares, and they are quickly becoming an Aussie household name for all your home furniture needs. And as of recording this video, they are trading at $7.85 with 945 million market capitalization. The interesting thing about Temple & Webster is that they have a drop shipping delivery model where 80% of their sales do not require them to hold inventory. Orders from Temple & Webster are sent directly to customers from suppliers. And to answer whether they have a product customers love, let's look at the repeat and first time orders. So the purple line is the repeat orders, and then the greenish line is the first time orders. As you can see, from March to June 2020, the repeat orders have spiked. But even before then, there is a general uptrend in terms of repeat orders. And if customers don't like, or if they don't love the product, what will end up happening is that the repeat order line will somewhat plateau, if not go decreasing. At the same time, this is happening to their commercial business as well. And the repeat orders are actually spiking even before the pandemic has arrived. And by the way, all of these slides are part of the most recent investor presentation slides. It's the most updated information I can find. Now, if you want a little bit more confidence to see whether people actually love this product, what we can do is we can look at Google Trends again. And this is March 2020, and this is around June 2020. The surge in increase is essentially an indication that people are looking for Temple & Webster. And this surge has translated in an increase, a very sharp increase in active customer base for Temple & Webster. And active customers are defined by Temple & Webster as people who have transacted with them over the last 12 months. Now, you can also look at the product reviews or Trustpilot for these companies, but I'll take those reviews with a grain of salt because those reviews can be gamed pretty easily. So, does Temple & Webster have a product customers love? It certainly seems that way given their repeat orders increasing. So let's talk about the scalability of their business model. Similar to Kogan, the online retail model is extremely scalable and very disruptive to physical retail stores. Instead of looking at opening up more showrooms and putting furniture inside and having more salespeople inside, Temple & Webster just need to focus on investing in their website infrastructure, customer service, and their supply chain. Granted, we know the business model is scalable. The last question is whether they can scale that business profitably. Now, in order to understand whether Temple & Webster can scale their business profitably, one of the easiest thing to do is to look at their most recent profit and loss statements. This is their most recent profit and loss statements in their investor presentation slides. So from 2019 financial year to 2020 financial year, the revenue have significantly increased. But what you want to pay attention to is delivered margin and contribution margin. These two numbers are essentially the operating costs of the business, and as a percentage to revenue, it's staying the same. Actually, if not decreasing, and delivered margin went up just a little bit, but because these two numbers have mostly stayed the same, the earnings before interest, tax, depreciation, and amortization went up by almost 483% from 1.5 million to 8.5 million. So can they scale their business model profitably? It certainly seems that way. And with $38.1 million worth of cash at the end of June 2020, along with another $40 million capital raising, they have a total $78 million in cash. They definitely shouldn't have any issues weathering the storm in the very short term because Temple & Webster have a very capital light business. Now, in terms of risk, the biggest risk for Temple & Webster is not exactly a demand problem, but a disruption to their supply chain and deliveries from their suppliers overseas. So far, it doesn't seem like the supply chain have been impacted, because if it did, the delayed in shipping needs to be announced on their website, and I haven't seen anything yet. When it comes to their economic moat, their digital expertise is by far their biggest advantage. While other physical retailers are trying to figure out digital, the learnings alone from 2011 would set Temple and Webster far apart from a lot of the physical retailers trying to come online right now. It doesn't mean that Temple and Webster is invincible. It just means that they have a head start compared to some of their other competitors. Again, this is a co-founder-led business. However, majority stakes is now owned by a managed fund over in the US, and the co-founders have a much smaller stake in the business. Full disclosure, I don't own this stock in my portfolio. Just for your information, I was planning to cover City Chic, and a few of you have suggested I cover a comparison between JB Hi-Fi and also Kogan. Let me know in the comment section below in terms of what you want to see next. Let's wrap up this video with a portfolio update. Now, just a quick portfolio update to wrap up the video. The CMC market side is worth approximately 53,000 Australian dollars at the moment. And yes, multiple people have requested an AMD video, so I'll be doing that in the near future. And following from my previous update on this portfolio, I have sold off my Milton Corp and InvoCare positions, reallocated back into Argo Investment, just because Argo Investments had a lot more well-rounded portfolio, and I really appreciate that. And Milton Corp had a little too much bank exposure to my liking, and it's more of a personal preference, and I sold off those positions, reallocated everything back into Argo Investments. For my stake portfolio, I have added another $1,700 US. So let me tell you what I bought. $700 is allocated to ARK Innovation ETF. I have a video coming up for that, so stay tuned for that. So ARK Innovation ETF invests in disruptive innovation technologies. So gene editing, gene sequencing, along with 3D printing for industrial applications, as well as autonomous driving. I've been following their work for a very long time. I'm very interested in the technologies, so this is just more of a personal interest to me. And the rest, which is about $1,000 US, is invested in my dividend growth companies. So that's basically everything else on this portfolio except for Tesla. Now, Tesla, I have a separate fund just for this, and it's mostly money that I don't need. And even if I were to lose everything here, I think of this almost as my contribution to helping our world move towards sustainable energy. So as Tesla price went down, I bought some more. And if Tesla goes down even further, I will go buy some more. Now, the only reason why I am so aggressive and so bullish on Tesla is because I think there are still a lot of upsides for the company, not to mention before the battery day. Battery day is in September. I'm really excited for that. It really just makes sense for me to put a lot more money towards Tesla, just because the cost of the electric vehicles has come down to a point that is getting very close, if not already cheaper than internal combustion engine vehicles. So this is just a personal choice, and make sure you always do your due diligence if you were to invest. Just don't follow exactly what I'm doing, because I could be completely wrong. And on that note, if you want to try a stake for yourself and wouldn't mind getting a Dropbox, GoPro, or Nike, I'll leave a link in the description box below. I'm not sponsored. I just really enjoy using this product. It's easy to use. It's a lot more affordable than trying to buy US stocks with CMC market. It's just incredibly expensive to do it on other platforms. So thank you for watching this video all the way to the end. If you learned something brand new, just make sure you gently smash the like button right there, because that will mean the world to me, and you are supporting me to go on the journey of creating content for you full time. And as usual, make sure you subscribe to my channel and click onto the bell so that when I release future videos, you'll be the first one to know. Until next time, my name is David. Otto will always do the honors, and see you very soon.